The broadcast is now starting. All attendees are in listen-only mode.
Welcome everybody to today's Interactive Brokers webinar, brought to you in conjunction with my friends over at Simplify Asset Management. I will introduce the team to you momentarily. They're going to be presenting, the title of their presentation is Disruptive Investing Disrupted. I'm looking forward to this one from Eric McArdle and Larry Kim, and their special guest, Tad Park from Vault Equity. Before I hand over, can I ask that, Larry, can you put up on the slide, on the screen for the guests, the disclosure slide from Interactive Brokers, if folks can just take a moment to read that while I go through some housekeeping as well. Today's event's being recorded 2 hours after the end of today's presentation. Look out for an email from Interactive Brokers with the link to today's recording. We'll also post it onto the ibkrwebinars.com page for this presentation, and we'll also post it to Interactive Brokers YouTube channel. I also want to point out there are two pieces within the GoToWebinar panel that you can access to interact with us. Firstly, there's the questions pane. If you have any questions for the team throughout the presentation, if you can enter them in there, the team will be able to see them, and we'll probably get to a Q&A at the end of the session if there are any questions. And the second thing I want to explain is that in the handout section, you can download a PDF of today's event, and that does contain contact information for the team over at Simplify Asset Management. So guys, without any further ado, I'm going to ask Eric and Larry to unmute their microphones, and Tad Park from Vault. And guys, take it away. I'm going to put myself on mute, and I'll be around in the background. Over to you guys.
Terrific. Thank you, Andrew. And again, we appreciate everyone joining us this afternoon for what's set to be an exciting discussion. If we can go to the next slide, please. So for those of you who are unfamiliar with Simplify, we are a young ETF firm made up of seasoned investment professionals that are focused on creating scientific yet easy to implement options-based strategies. And our ultimate goal is really to provide new portfolio building blocks that focus on beta exposures, such as the S&P 500 or NASDAQ 100 index exposures, as well as disruptive technology exposures that we're going to be covering in depth throughout this presentation. Though our products all have a slightly different focus and use case, the commonality among the lineup is that we couple long-only equity exposure with a managed options overlay to produce convexity, which is a non-linear payoff during extreme market events to the upside or downside. And again, that's going to look a little bit different depending on each product, but today we're going to focus specifically on how we do that for disruptive products and themes. Next slide, please. So in our partnership with Volt, we have launched 4 disruptive technology ETFs that focus on distinct disruptive themes, the first of which being VCAR, our Volt Robocar Disruption and Technology ETF, followed by VFin, Fintech Disruption, VPOP, Pop Culture Disruption, and VCloud, Cloud and Cybersecurity Disruption. Next slide, please. And so for today's conversation, we want to really address why we brought these products to market and what is driving the portfolio construction here. And so the first concept that we really want to hit today is, why do we want to concentrate our exposures anyway? What are the benefits of that? And what are some examples of where concentration has worked out? Additionally, we want to discuss how to identify disruptors. How can we pick the winners or the future winners out of a very crowded field, right? That's a very challenging thing to do. We're going to look at that concept in the autonomous driving space. And then we're going to ask you, how much do you love your insurance company? Be interesting to hear the results on that. Further, we're going to discuss convexity, why we want to use it, and how it is a powerful force for enhancing performance and offering protection in portfolios. And then finally, we're going to wrap up and talk about how we can get exposure to all of these ideas in an easy to implement package. Next slide, please. So when most people think of concentrated stock positions, they think of the Wall Street Bets crowd, GameStop, young investors on Robinhood YOLOing their investment capital on call options. And as we were discussing prior to the event, things like Dogecoin and cryptocurrency, right? These very concentrated, high octane bets. But interestingly enough, the Oracle of Omaha, or Warren Buffett, which is one of really the most prolific investors of our time, has used concentrated positioning to his advantage in building his wealth. And Buffett says, it's crazy to put your money in your 20th choice rather than your first choice. And I operated mostly with 5 positions. If I were running 50, 100, or $200 million, I would have 80% in 5 positions with 25% for the largest. Buffett's name and reputation is married to concentrated bets. And there are stocks like Coca-Cola, Amex, and even Apple that are associated with his success. Next slide, please. So if we move away from a storied investor like Buffett, right, and we look at the broader index constituency of, say, the Russell 3000, we really wanted to analyze what concentrated bets could do among a crowded pool like this. And what we found in looking at a study put out by JP Morgan that assessed these index constituents from 1980 to 2014, that the bulk of the names in the index actually lagged or didn't even break even on performance for this duration, right? So on average, if you were to just pick a stock in this index, you would have lost money. However, a very small number, about 7% to be exact, produced incredible outsized gains. And you can see that right tail on the right-hand side of the distribution curve. And so today we want to pivot and now look at what makes these extreme winners different and what do their growth cycles look like relative to the other companies that, say, have underperformed. And for that, I'm going to bring Tad in.
Thank you. So as we can see in this slide, this is looking at the 2nd to 98th percentiles of the growth curves of some of these disruptive companies. Clearly, there are patterns for these companies that win, and they are some of the largest tech companies in the market today, as we well know. But the key takeaway here is that they don't just gradually go up like a normal stock. They suddenly have these drastic moves. And over here, it's showing that each of these S curves in the stock price happens over a 2-year period, and they go up at least 100% to 250%. So this is just showing that these types of stocks and these types of companies will behave very differently than a typical company. So if we look in the next slide, the indicators in red here is showing the Gini coefficients. And what a Gini coefficient is it's showing how much consolidation there are in these industries. As you can see, the higher Gini coefficient industries are actually technology industries. So they're all indicated in red, to the exception of soft drinks. So there is some monopolistic behavior with Coca-Cola and some soft drinks. But for the most part, the monopolistic behavior is all concentrated in tech. So tech tends to have a winner-take-all, a very high Gini coefficient, very high monopolistic tendency behavior. And this is totally makes sense, because when you have other industries that like specialty stores and different things where they're constrained to local economies, you don't have a winner-take-all dynamic. But when you have tech, it's rapidly scalable and it does have this winner-take-all dynamic. And that also means that their stock price could also have a very different dynamic and different growth curve than a typical company. If you can see in the next slide. So back in 1999, everyone knew that internet was the future. And this was right before the tech crash, but everyone knew and everyone was saying, hey, let's like just pour a bunch of money into search. So if you poured everything into search, one of the big problems here is that most of them was not the dominant search engine of that day. So the actual winner, as we all know, is Google. And the key here is with search is like, how do you know which of these companies was going to be the winner back then? And if we just bought each of these companies in direct proportion, then you would only have a very small amount of Google, and everything else would actually end up being either bankrupt or not the dominant search winner. So in terms of investing, this is why it's so important to help and try to identify the winners. And we have believed that it is possible to try to identify these winners by trying to do a first principles analysis of what actually is necessary to solve this problem. So while all the other search engines were basically doing the same thing, they were just showing search results and that kind of thing. The key problem to solve was relevance, and it was not just showing directories and doing things based on keywords and stuff. And Google was the only one that was actually tackling the key pain point of this industry with relevance. And with their PageRank algorithm and their particular technology, it ended up being the real solution from a technological angle to solve this problem. If we see in the next slide, we can see what happened. So when they were focusing on the key problem of relevance and they had the technology to do that, then over time, it's very clear what happens over time, and then they secure their lead. So this begs the question: is it even possible to identify disruptors? We definitely believe so. And the companies that knew what was important and they knew what to do, the right technology, the right culture, and the right focus, we believe have a high potential to being a disruptive company. So to go into an example of autonomous driving, this is one of the biggest opportunities that we believe that there are today. So there's disruptors all around us, and they're waiting to take on this this market. And autonomous driving is one of the biggest challenges and biggest opportunities for disruption that everyone recognizes. So no one's really questioning, is this a big market opportunity or not? Like, everyone knows this is a multi-trillion-dollar or trillion-dollar opportunity. If someone can get a robocar to actually drive us around and for cheaper, then it would disrupt everything. It would disrupt ride hailing, it would disrupt car ownership, it would disrupt our commute, where we live, because people could just get in a car and then they can sleep or do work on the way. And if you don't actually have to do the driving, then it would open up whole new industries. You would get rid of parking lots. There's a lot of disruption that can happen and would have multi-trillion-dollar impact. So the question is, with all the contenders to the throne, GM's Cruise, Ford's Aptiv, Waymo, Uber until recently, all these different companies trying to go into autonomous driving, is there any way that we can find the winner? Because we don't want to do what happened back in 1999 and invest in everything, and vast majority of them all go bankrupt when the winner emerges. And is there any way that we can have a higher than normal likelihood of finding the winner? And we believe that it's absolutely possible with a first principles breakdown. So in the next slide, these are some of the reasons that we think, some of the pillars that we think are important for a winner in autonomous driving. So they need to have all of these aspects, the redundant camera data, a low maintenance electric fleet, the chip, the improvement culture, and all of these need to be there in order to solve and win in this space. Just like for Google, the right thing for them to focus on was relevance and their PageRank algorithm. Here, the right thing to solve and win this space, we believe, is the camera data. So all of the other companies out there that are actually trying to solve autonomous driving, they use LiDAR, and they think that LiDAR and cameras is what is needed to solve the problem. And we've seen what happens when they try to do that. The original Waymos were probably over $1 million, and now they're probably at $200,000, and then the price keeps going down. But the problem is they won't ever get enough cars on the road, the millions of cars that they need on the road, to get enough data to catch up. For Tesla, on the other hand, they have 1 million cars on the road. They're bringing in all the camera data, and they're solving the main problem that needs to be solved in self-driving, and that problem is perception. So if you don't have perception, you can't solve a lot of the problems that you need to solve. Like, for example, are you supposed to wait? Is there a kid that's going to come out? What do deer do? Do deer actually run out, or do they stay on the side? All of those decisions, those are decisions that need to be made by the AI computer. And this is not something that LiDAR and those kind of things are best suited to solve. So from a technological point of view, once you have massive amounts of camera data, you can do quite amazing things with AI. And AI has advanced far enough that many problems can be solved with just the AI data. So if we look in the next slide, we can see that Tesla has a massive lead in the amount of miles driven and the amount of data that is necessary to solve this problem. They have more than 100x data lead of all the competitors combined, including Waymo, which is in number 2. So to solve those problems of perception, we do need all that data. It is not LiDAR, because with LiDAR, you can, LiDAR is the laser imaging. You may have seen like those little spinning things on top of the cars, or pictures of those for a traditional autonomous car. That will basically tell people how far things are, but they won't actually tell you what the thing is, or the camera is best for telling you what the thing is and what the computer is supposed to do. And for the last mile of autonomous driving, like, we've seen demos of autonomous driving, everyone has shown a demo, but the last mile of safety for autonomous driving is that perception piece. And to actually solve that piece, you need perception. To solve the perception piece, you need data. And with this vast data lead, with the vast lead that they have in the chip to actually process this data, with the vast lead in electric cars, you also need electric cars to have an autonomous car. And the other companies do not have electric car. So if you don't have all of these aspects, then you won't be able to actually win in this race. So we believe that just by breaking it down to what is the core piece of the problem that needs to be solved, we can see who is in the lead, and we think that Tesla's way in the lead for autonomous driving. We can go to the next slide. We apply this type of thinking to many different industries. So we say, hey, what is the biggest pain point in digital payments, for example? And it's really like, yeah, there are these very big payment companies, but it's super painful for you to try to see what it is on your credit card statement, or what actually happened. And if there was a mischarge or a double charge, it's like a huge payment, a huge nightmare. So we look at the companies that are actually, disrupting that and making that way easier for the consumer, way easier for everything, and reducing that friction. And we could do the same thing with insurance. So if we could go to the next slide. Here, this is just to look at just the size of the opportunity here. So we know that Airbnb and Netflix were very disruptive, and they were disruptive. They took a huge chunk of these industries, like 10%, 20% of these gigantic, nearly $1 trillion industries with a whole new way and a tech-forward way of viewing the problem. Lemonade is in the insurance industry, so it's also over $1 trillion, but as you can see, they're just getting started. They're a tiny bit of the industry. There's a huge total addressable market, and we believe that they have the potential to eat a lot bigger portion of this market. So if we look in the next slide, we believe that the edge and the technological edge to gain market share in insurance will be with the data. And this is just an example between traditional insurance and Lemonade in terms of the number of data points that are collected. So with traditional insurance, if you went online and you just filled out a form, max, they would probably ask for like 20 to 50 questions and you're just filling out all those forms. Or you might be on the phone and then, the agent is filling out the form for you. But with Lemonade, they only accept people through like the chatbot. And then when you go through that platform and everything is digital, they're collecting many, many data points, over 1,600 data points in this process. So when you file a claim, when you go into the system, everything, they're all showing data points, and there's a lot more data than just filling out a form. So it might be your IP data, whether you change your answers, whether you read the terms of service or not, and all these different things. They all seem insignificant to us, but when it's fed into an AI machine learning algorithm, it's able to assess risk. And if it's able to assess risk and actually use that data, then you can actually offer lower premiums to your customers or reject customers that are too high of a risk. And that actually accelerates the potential disruption in insurance because the existing players will get the higher risk customers, and then the lower risk customers that are actually really great, you can offer them a lower premium, and there's less likelihood of them committing fraud and those kind of things. So if we look in the next slide, this is just an example of how you can use AI when they actually submit the claim. So if someone's submitting a claim through the app and they actually have to record a short video of themselves, the technology can actually put vector points, and this is just an example, putting the vector points over the ears and eyes and nose, and it just automatically identifies. But you can identify like way more points than this. And from there, if you just remove the image and you just keep the vector points, basically you can identify like, facial expressions and those kind of things. So for us, it might be very hard for us to identify, but for a machine, if it knows that people who are, stuttering or like really, really hard, like, doing all of these things that indicate that they're probably not telling the truth regarding the claim, you can do that without the image, without the skin color, without any of that stuff. So a normal human would be, might introduce racial bias, might introduce all these different things, but the machine can actually get rid of the racial bias. It can get rid of all those things and only identify the things that are increasing the risk and actually identify whether there should be an immediate claim payout or not. And that's why Lemonade was able to get a world record for the speed in a claim payout, and they were able to pay out a claim in 30 seconds. So a normal insurance company would, take hours or days or a long time, like right when your house burned down, like the last thing you want is a slow claim payout process. And Lemonade's tech-first approach is able to speed up that claim payout process, lower the cost for the company, and increase the love of the product for Lemonade as an insurance company. And we believe that this is going to allow them to accelerate and actually capture more and more market share in insurance. If we can go to the next slide. So this is for our cloud and cybersecurity theme, and we've also think that there are certain things that are very important for cloud, very important for security, and for these, it continues to apply for more and more of these industries that are in tech. So in the post-COVID world, companies are looking for the best cloud solutions and the best cybersecurity. So before, it was okay to just have a IT team of like 5 people, and then you pay them $500,000 a year to try to secure your company. But now that everything's on the cloud, the hackers are getting better and better, and they're just focusing on the weak points. So even a IT team of 5, even if it was IT team of 50, it wouldn't be enough to plug all of the potential security holes that are coming out there in a rapidly, unsafe and more insecure environment. So the only way for companies to actually handle the increasing number of threats is to go into the cloud. So in a cloud cybersecurity context, the more that attackers attack the cloud and attack a particular company, all the companies get stronger at the same time, because the entire cloud gets stronger at the same time. And they have to basically, these hackers have to beat against the combined knowledge of everyone at the exact same time, which makes it very difficult to penetrate and breach the system. And we believe that over time, more and more companies will realize that they have to eventually go onto the cloud for cybersecurity and change the way that they thought about things, and change the way that they approach security. And that will continue to disrupt this field as companies start to consolidate around the winners within cybersecurity and cloud. Okay, in the next slide. This is a non-traditional theme, but one I'm really excited about. I believe that the way that we interact online, it's not done, and the social media landscape is not done. So we see that there's like a lot of disruptive potential in this space, and there's this attention economy that people are not taking advantage of. So companies like Spotify and Snap are actually leveraging like a very fast-growing part of this landscape. So Spotify is not just an audio company. They're really leaning deep into podcasts, and they're actually taking influencers and like the new way that people want to learn about the world and just listen and do all the stuff. They're actually capturing those that share by all of these exclusive deals with different influencers. And then Snap is also taking really good use of AR and immersive experiences. So when people want to try out, makeup or these different things, they can just try it out within the app, and they can try out different makeup looks, or they can try out glasses or different things like that. And we believe that the next wave of how people can actually interact with things in the digital world is just getting started with augmented reality. So in the next slide. So we talked about the first aspect, which is how do we identify these disruptors, and how do we identify leaders? And I think that's very, very important, because out of a whole sea of many different companies, we really need to identify who has a higher than likelihood, higher than normal likelihood to become a leader in this space. Then we talked about concentrating on these disruptors. So for our ETFs, we actually concentrate on these names for now. And as we continue to look at the aspects of disruption and what is actually important to disrupt a particular field, we continue to watch, and we may change these anchors. And then finally, we apply a overlay of calls and downside puts. So the reason for this is the markets may not fully realize the disruptive potential of some of these companies. So if Tesla, for example, is 700 mil right now, but then they are on track for a multi-trillion-dollar valuation in the future, the calls are actually very relatively cheap, because if there's a sudden move in the stock price, the call options will boost the returns for a very cheap amount of premium. And then same thing with the puts. They may actually not be priced in of a broad market sell-off. So by having the calls and the puts on both sides, we can actually take advantage of market moves that are not priced in for disruptive companies. So for further details, I'll send it off to Larry to talk about Convexity.
Okay, thanks, Tad. So Tad and his team over at Vault Equity are doing the research and making the security selection for these disruptive theme ETFs. Okay, how then do we complete the portfolios and add convexity? Well, first, let's have a brief discussion on what is convexity. Because to these portfolios, we are adding both downside convexity and upside convexity. So basically, if you take pretty much any asset or any asset class, like say, for example, the S&P 500 or the NASDAQ 100 or any individual stock, they have a return profile that is linear. So that's represented by this black dotted line. So for example, the S&P 500, on any given year, it might have a large negative return, it might have a large positive return, or anywhere in between in a straight line. So convexity is adding this convex shaped curve to the return profile. So we like to call it the smile. So what we're doing is, by using put options, a small budget allocated to puts, we can add this downside convexity. So if the underlying assets are declining significantly in value, the put options will gain significantly in value, offsetting somewhat the decline in the underlying asset. Conversely, over here on the right side, we're looking at convexity on the upside, which we gain through a small allocation to call options. And so if the underlying asset is increasing in price, the call options will increase a magnitude of that higher. So this gives us convexity, which is what you want to have. You want to have positive convexity in your portfolio. It gives us convexity on the upside as well as convexity on the downside. If there is no real volatility in the underlying assets and in the markets, and we're having a low volatility regime, then those put options and call options will not add value. We're spending about 2% of the fund's net assets on these options. So the worst case scenario is that if there's no volatility at all, those options are not adding any value. So that's a brief discussion of what we're doing with convexity. This may be a little bit hard to screen, so to see on your screens, so you may want to magnify it or go to full-size screen. But this is just an example using VFin on how this works in practice. So you can see the highest conviction position is Square at about 21% of the portfolio. So we are adding right side, upside convexity by including a small amount of call options on Square. Similarly, the next highest conviction position is Lemonade. We're also adding a little bit of call options on Lemonade. So this is adding the upside convexity. Next, we have the next convection holdings, which are PayPal, Spotify, Mercado Libre, and Pinduoduo. Finally, we are filling out the balance of the portfolio with a little bit of growth beta by investing in QQQ. Okay, so that accounts for the underlying holdings and the upside convexity. Finally, we're completing the portfolio by adding a small amount of NASDAQ 100 put options. So these are growth positions, and so chances are, if they are declining, the NASDAQ 100 is declining as well. So the put options are a very low-cost way to gain exposure to downside convexity, which will hopefully offset portfolio declines in the event of a bear market in the NASDAQ. And so if you look at our overall lineup, as Eric reviewed at the beginning of the presentation, the 4 portfolios at the bottom that you see in black are the disruption thematic ETFs that we just reviewed. In addition, the first 3 funds at the top that begin with the letter S, so SPYC, SPD, and SPUC, these are based on the S&P 500, adding downside convexity, upside convexity, or both. And then we have 2 products that begin with the letter Q, QQC and QQD. These are based on the NASDAQ 100 that we are adding either downside or upside convexity or both. So that completes the current lineup of the simplified product. We have lots of content on our website. Our website is simplified.us. If you register on the website, you can see we have many case studies, white papers, and blog articles that discuss convexity and the power of disruption as well. All right, so that is VCAR, VFIN, VPOP, and VCLOW. So all of these are exchange traded funds, so you do not need an options agreement or anything like that. As long as you have a US-based brokerage account, you'll be able to buy these ETFs pretty much anywhere just by entering these ticker symbols. All right, so that's it. Thank you. Just please visit Simplify US and vaultequity.com for more information. All right, Andrew, that concludes our presentation.
Very good. So if the audience has any follow-up questions, please put them into the control panel. Jin asks the question for you guys. What asset class, sector, or region do you see to be the most negative convexity in the next 18 to 24-month time frame?
I think I can take this one. So Harley Bassman has recently joined our firm, and for those of you that don't know him, he's known as the convexity maven. He's very experienced in this field, and he's pretty much all about convexity. So I think he described the concept in a very clear and simple way. He says, if you are betting so you can make 4 if you win, but lose 5 if you lose, that's a negative convexity bet, right? So your opportunity is not nearly as big as your risk. And so one of the areas where we're seeing that attribute right now is probably investment grade fixed income and treasury bonds. So if you win, you're getting whatever, 1%, 2% yield. But if you don't win, the potential returns, if rates continue to rise, are severely negative. So that's an example of a negative convexity bet that we see out there. I don't know, Eric, if you want to add to that.
Larry, I think you did a great job covering that. And the only thing that I will add is that this is a little bit outside of a particular asset class, but it is a strategy that has become much more popular in recent years. Selling covered calls or using put right strategies to pick up either immediate income or some kind of near-term income play. Obviously that strategy is concave, right? So that would be negative convexity. And so going to Larry's example about, winning or risking a good amount to win a very little, right? We view those strategies in a similar fashion. And we think, especially given the propensity for fatter tails or more extreme outcomes in the future, selling a call to cap your upside or selling a put to generate income while also being on the hook for downside risk, we think that those are, I don't want to say sucker bets, but they can have an outsized amount of risk for what you're looking to gain from the trade. So I'll leave it at that.
Here's a question coming in just before I was just about to wrap up there, and It's from Deb. Does the convexity management using options make it expensive for long-term holding, or are these only meant for short-term holding? Are there less expensive ways for convexity by identifying companies that will benefit when the focus company tumbles?
So I can take that one, and that's a good question. I think one of the things that we try to adhere to here at Simplify is maintaining a systematic process for our option overlays. And so we have a set structure or a defined rule set that dictates how we purchase call options or how we purchase put options, and then subsequently how we will roll the positions or potentially monetize the positions. And so what that generally looks like is you're going to have either strikes or different expiries that are spread across different levels, right? And so we're basically providing a laddered level of coverage against either type of move to the upside or the downside. Because we're using a fixed budget for our option overlay, if, let's say, volatility or so in this case, implied volatility, forward looking, right? Let's say that's more expensive, then we will still maintain our budget and buy as much notional coverage as possible. So in theory, if volatility is more expensive, we can buy a smaller quantity of options, right? Or on the other side, if volatility on a forward-looking basis is cheaper, then we can buy a larger quantity of set options. And so we're very strict in terms of how we play with that budget. We don't want to overextend too much. And we also, from a thematic standpoint, we have, I don't want to say concentration limits, but essentially we're going to make sure that our anchor positions don't have much more than, say, 25% of the portfolio in general.
I would add to that what Eric said, that we are spending, so the expense for adding the convexity is about 2% of the fund's assets per year. We view that as very inexpensive insurance compared to some of the alternatives. So for example, if you wanted to protect your portfolio against the downside, you could put 40% of your portfolio into treasury bonds that are yielding less than inflation, right? So they have a negative real yield. So that we view that as a far more expensive to protect portfolios than a 2% spend on options. And the last part of the question about identifying companies that will benefit when the focus company tumbles, that's very difficult to do because for the most part, equities are positively correlated with each other. There's no perfect way that you're going to find one company that has an inverse correlation to another. On the other hand, we do know that those NASDAQ 100 put options are perfectly negatively correlated with the NASDAQ 100 itself. So you really can't buy a more pure or pristine way to gain convexity than through the put options.
Okay, one more question. Okay, Deb says thank you, that makes sense. Okay, guys, Eric McCardle and Larry Kim from Simplify ETFs, thank you very much for joining me today to present today's webinar, and to your guest, Tad Park from Vault Equity. Thank you very much indeed as well. Guys, look out for the recording link later in your inbox. Don't forget that there is a handout for today's presentation if you want to take a look at that. And all available from ibkrwebinars.com later on. Eric, Larry, and Tad, thank you again. And I'm going to leave you guys to sign off and say goodbye to the audience.
Thank you.
Thank you.
Bye, folks.